What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. Good morning, everyone. This is Ryan Pulis with another episode of the CPA Zone. I guess it's morning for me. It may not be for you, depending on when you're actually listening to this. So today we're going to talk about, should I sell my primary residence or convert it to a rental? I get this question quite often. And honestly, it's going to come down to personal preference. But let's talk about the different tax impacts of this decision. So deciding whether to sell your primary residence or convert it to a rental property is going to depend on multiple factors. There's tax implications, your financial goals, market conditions, the current real estate market, that would play. So this is a tax and accounting podcast, so we're going to focus on the tax side of things. So let's start with selling your primary residence. So there's the primary residence exclusion available under Section 121. So that's if you lived in the home for at least 2 of the past 5 years, you're going to be able to exclude up to $250,000 of the capital gains. If you're single, if you're married, that exclusion doubles to $500,000. So that is an exclusion. Exclusion means tax-free. That is fantastic. Tax-free, always better than tax-deferred. Now, gains above these limits, if you have a really large gain, those are going to be taxed as long-term capital gains. The selling your residence before converting it avoids depreciation recapture. So if you convert your home to a rental property, you're going to start depreciating it. The Section 121 exclusion only applies to capital gains. So if you have depreciation recapture to deal with, then that you're still going to pay tax on that recapture. We mentioned the housing market conditions can play a role. So obviously, if the housing market's strong and you can get a large gain, selling's probably going to be more advantageous for you. If you convert to a rental, if the market's down, you might want to convert to a rental and see how things look. So if you convert to your property to a rental, you're going to claim depreciation deductions on the property, on your rental, just like any other rental that you have. So that's probably going to have some positive cash flow, hopefully, without paying any tax. Depreciation is going to shelter that income. Your depreciable basis is going to be determined by the lower of the current value of the home or your original cost basis. So usually you're using your original cost basis at the time you purchase it. You don't adjust to the current fair market value when you convert your property to a rental, unless the fair market value is lower than what you purchased at. Now, when you eventually sell your rental property, you'll have to pay tax on the capital gains as well as the depreciation recapture. Your depreciation recapture is going to be capped at a rate of 25%. Capital gains will vary depending on your income bracket. It could be 0, 15, or 20%. Now, if you sell the property within the first 3 years after you move out and convert to a rental, you can still use that primary residence exclusion under Section 121. Now, as I previously mentioned, Section 121 does not apply to the depreciation recapture, but it will still make those capital gains excluded from tax up to those limits: $250,000 single, $500,000 if you're married. So if you lived in the house for 2 years and then moved out and rented it for 2 years, then you can still exclude the gain from your taxable income for just the capital gains portion. Now, which is best? Again, all those factors are going to come into play. Generally, you're probably going to want to sell and take the tax-free gains, because tax-free is always better than tax-deferred. And if you do convert to a rental during those first 3 years, maybe the market's down and you're not going to have any gains to exclude. That's when it may make sense to convert to a rental. Try to ride it out for 3 years. If the market recovers and you have some gains to exclude, then maybe you sell, or maybe you keep it as a rental long term. You want to make sure it aligns with your investment strategy and that you understand and are comfortable with the future tax implications. If you're fine losing that 121 exclusion, or maybe there's just not enough gain there to make it worth it, you want to keep this, you think this property will cash flow and it makes sense and fits your investment criteria, then by all means convert it to a rental. What you don't want to do is get emotionally attached to the home. It's your primary residence, you're just hanging on to it because you're emotionally attached. Run the numbers, make sure it makes business sense for you. So that about does it for our brief conversation on should you sell your home or convert it to a rental. We do have one question, so one Q&A to go over, and this came in from a listener asking, how do I revoke my company's S corporation election? So to revoke your S status, you have to submit a written statement to the IRS. It's going to contain the business information and basically a statement indicating your intent to revoke the S corporation election. Now, this written statement has to be signed by more than 50% of the shareholders in terms of stock value. So if you have 10 S corp shareholders, you're going to need more than half of them to sign the statement. If you're the sole owner, then you're going to get 100% just signing by yourself. So that written statement will revoke the S corporation status. Revoking your S election is not that difficult. However, you need to understand that when you revoke your S election, your business immediately converts to a C corporation. So if you're an LLC that elected to be taxed as an S corporation, when you made that S election, you technically became a C corporation, which then made the election to be taxed as an S corporation. So when you revoke your S corporation status, your business will now be taxed as a C corporation. If you don't want to be taxed as a C corp, you may qualify to file a Form 8832 to change that classification, but just know the initial status is going to be a C corporation. So if you're planning to do something else and change that to something other than a C corporation, make sure you file your Form 8832. That about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.